It's a wonderful pleasure to have Tyler Goodspeed back to tell us about the history of economic contraction.
All right, well, thanks. It was great to be back with friends, former colleagues. And definitely this is not an opportunity to turn down, to have research on recessions and to have the current and former chairs of the MER Recession Dating Committee. As some of you may know, I'm both an historian and a card-carrying PhD economist, so I sometimes wear both hats or one or the other. So before getting started, I actually wanted to begin with a story. And please do indulge me because this is a fascinating story to me. So many of you may be familiar with the recession that began in 1873. It was known for a long time as the Great Depression until an even greater one came along. And the precipitating event was the failure of the widely respected banking house of J. Cook. J. Cook was a really interesting character. So he was born in a frontier town in Ohio. By the age of 9, he was already selling trinkets out of his uncle's dry goods store. By the age of 37, he had retired, worth approximately the contemporary equivalent of $100 million after a very successful investment banking career in Philadelphia. But he didn't stay long in retirement because around the time of the outbreak of the Civil War, he went back into the investment banking business, not because he was looking to make more money, but rather because his son and nephew were of the age at which he thought they should get some experience. But it was quite fortuitous because the state of Pennsylvania was trying to move a $3 million bond issue that all of Philly's bankers said, you can't sell that at par. And Jay said, no, I think you can sell that at par on a wave of patriotic zeal. Sure enough, he did. And he sent a letter to Jefferson Davis, the president of the Confederacy, saying that the North's millions stand behind the effort against this rebellion. He ends up selling about a quarter of the federal government's debt during the war, ends the war, not just wealthy, but fantastically so. He buys a palatial mansion north of Philadelphia and a castle on an island in the Great Lakes, where he's starting to spend more time. When he was briefly working in a dry goods store in St. Louis as a teenager, he'd heard firsthand the stories of Lewis and Clark. And there's a new railroad project, the Northern Pacific Railroad, that aspires to connect the Great Lakes, Duluth, to a wonderful natural harbor in Puget Sound in the Pacific, Seattle, and that crosses some of the most fertile agricultural land in the country, if not the world, abundant natural resources. And Jay is impressed by the recent completion of a survey of the Yellowstone River Valley, and he starts lobbying the Grant administration to make a national park because he sees tourism potential. Now, the problem for Northern Pacific is that this was going to be entirely privately funded. The more famous Union Pacific and Central Pacific, they had benefited from federally subsidized loans. Northern Pacific was going to be entirely private. And after commissioning some surveyors and lawyers, January 1st, 1870, Cook inks the deal. He's going to be the sole underwriter for this massive undertaking. And it initially goes pretty well. So they break ground for the first time. They finish a connector line from Duluth to St. Paul. But then challenges start to mount. So
by contemporary standards of California's high-speed rail,
it's doing pretty well. So the surveying teams start to trespass on traditional indigenous hunting grounds and occasionally come under attack by forces of the legendary Sitting Bull. The forces never numbered many, but the press covered these attacks in lurid detail, in part because the flamboyant George Armstrong Custer was providing coffee. You then had, in the fall of 1872, just as the Grant campaign for re-election was in its closing stages, the New York Sun breaks this incredible scandal of corruption at the Union Pacific, where basically the directors were attempting to defraud investors in the Union Pacific Railroad, casts a huge pall on U.S. railroad securities. But then there's an additional complication, and it's the arrival in St. Paul of this man. He had an aristocratic bearing, and locals noticed that he had his harness, horse's harness, bore an Earl's crest, and his signet had the initials, his monogram had the initials GHG, which were the initials of the recently lost Earl of Aberdeen, Lord Gordon of Aberdeen. He had gone missing at sea, and he deposits $20,000 to $40,000 in a local bank, and lets people know that he's in the market to buy about 50 or 60,000 acres of land along the future route of the North Pacific to relocate the tenants from his overcrowded Scottish estates. Northern Pacific, they immediately leap to action. They organize a surveying party for him, white glove service, French champagne, a long wagon train, spend the equivalent of millions on this. And they even fly the banner of the Clan Gordon. He leaves at the end of 1870, has selected tracks, but never executes the transactions. Goes to New York, gets some fancy rooms at the Metropolitan Hotel, then owned by Tammany Hall boss Tweed. And he conveys to the embattled president of the Erie Railroad, one Jay Gould. Some of you may know him for having, he was a brilliant financier. He orchestrated the failed attempt to corner the market for gold a few years before. And he's trying to battle off some English investors who are saying, we want higher dividends and you need to stand for re-election each year. And Lord Gordon says, I control directly or indirectly 60,000 shares in your railroad. And I'm willing to back you if you make a few reforms. But in the course of my investigations, I've incurred about $1 million worth of costs. And I think it's reasonable to expect that I'd be reimbursed for that, at least in half. Gould cobbles together $500,000 in railroad securities and cash, hands it to Gordon, asks for a receipt. Gordon hands it back and says, my word should be enough. My honor should be enough. Gould accepts that. A couple weeks later, he learns by telegraph that Gordon is trying to sell the securities in Philadelphia. Instead of going to the police, Gould then brings the police commissioner of New York City and a judge and Tammany Hall boss Tweed to the Metropolitan Hotel and says, if you don't return these securities and the cash, I'm going to haul you to Ludlow Street Jail. Gordon returns it, then tries to countermand the cancellation of the security sales. Gould gets a warrant for his arrest. There's going to be a trial. In the middle of the night, Gordon absconds to Canada, where after an extrajudicial extradition attempt, he's eventually located by Canadian magistrates in Winnipeg for some jewelry theft in Edinburgh and London. Before they can extradite him, he, in the words of the contemporary press report, blows his brains out. The reason I tell you all of that is because the press at the time covered this blow by blow, especially in Europe. And so you had editorials and letters to the editor asking what was going on in the US railroad industry. And they even noted that how is Gould still being sought out at all, given his reputation? And they wrote, only when those who still control the largest railway interest in the United States are no longer found to flock together as one of a feather, as Jay Gould, might it become possible for distant shareholders to regard their American investments without distrust. So by 1873, somewhere 1873, Jay Cook, who had been hoping to sell $100 million in Northern Pacific bonds in Europe alone, they're going days without selling a single bond. And in the meantime, he's extended $1.5 million in overdrafts to the Northern Pacific because they need to build track to sell bonds. They need to raise money by selling bonds to build track. He's got millions of dollars in unsold and increasingly unsellable bonds on his books. And for every previous tranche of bond sales, he acquired equity in Northern Pacific. So he's got his entire asset side of his balance sheet is frozen. And then this happens. In summer 1873, a strange cloud appeared in the American Midwest and Plains. And actually the pioneer children's author, Laura Ingalls Wilder, wrote about this. She noted a strange cloud, unlike any she had seen before, approach. And it sort of shimmered in the sun. And then something hit her head.
Climate change.
And it was a grasshopper. And Laura Ingalls then realized that the cloud was hailing grasshoppers. In fact, the cloud was grasshoppers. Now, this was a devastating shock for a railroad whose main pitch to bond buyers was that this is great settler community. And settlers who had already settled in the greater Midwest and Plains area started writing back to Norway, to Ireland, to Germany. They sent letters noting what was happening. And by the way, this shock came back in 1874, came back in 1875, came back in 1876. One swarm in 1875, Albert Swarm, was larger in area than the state of California. And actually, so key to this bond pitch of attracting European settlers was that they named the capital of the Northern Dakota Territory Bismarck. So by September of 1873, the Cook's partner and head of his New York office gathers some of the biggest bankers in New York together, and he says, I need $1 million in cash now. They said, what can you offer for collateral that's not Northern Pacific? He says, nothing. They say, no deal. And within minutes, he closes the doors. Philadelphia and Washington have to do the same. Dozens of banks immediately suspend payment. And by the way, at the same time, the United States has just demonetized silver. Germany demonetizes silver, so you get a deflationary impulse. But what is fascinating, despite all this having to go wrong and go wrong in a very chance way, immediately Cornelius Vanderbilt says, well, this is the folly of building a railroad from nowhere through no man's land to no place. And even after the railroad is eventually completed, so this is the Golden Spike ceremony, they are lampooning this as a charlatan huckster endeavor. So you can see a genuine English lord. They're trying to attract these sober investors. They're advertising a genuine English lord, a Bavarian general who looks a lot like Bismarck, a caricature of a German baron, and the trombonist there is playing from the New York Sun. If you read Kindleberger, say, or any number of encyclopedias of US business cycles or depressions, you would probably, oh, and by the way, before I get to that, do you know who owns the Northern Pacific Railroad today? Warren Buffett.
Yeah.
The most legendary value investor of all time. I mean, so if you read Kindleberger, Manias, Panics, and Crashes, you would probably surmise that railroads were serial killers of economic expansions in the 19th century United States and United Kingdom, 1837, 1857, 1847, 1873, 69, 87, 93. But if you look at the cumulative mile of railroad track in the United States and United Kingdom, it is remarkably faithful to trend. And there is no instance in which a few years after a recession, the cumulative mileage doesn't catch up to where it would have been had it continued uninterrupted along trend. So those slowdowns, no stops. This is not a stepwise function. The slowdowns during recessions are negative deviations from trend. The preceding expansions are not positive deviations from trend. I think this speaks to one of the central theses of the book, which is that we are pattern-seeking mammals. It's how we process incoming stimuli and match those features to patterns that we've stored and encoded in our memory. So it's called feature analysis, and it's part of why many of the early cycle theorists, so William Petty, Clement Juglar, were trained as medical doctors, and they would discuss economic fluctuations in medical terms: crisis, malady, remedy. And Kindleberger, he wasn't trained as a doctor, of course, but he would refer to biologic regularity. And this process of pattern recognition has served us very well as a species. I mean, it's why we don't eat colorful mushrooms. It's why we don't drink stagnant water, because it often helps us to correctly identify genuine patterns to observed phenomena. And we call those epiphanies. But this pattern-seeking nature can also lead us to falsely identify incorrect patterns, or else to assign patterns to phenomena that are fundamentally random. So when Kindleberger was born, the year he was born, there was great fear of fire and plague, because the last time Halley's Comet visited, we got fire and plague. Now, one epiphany that, we call those epiphanies, in contrast to epiphanies. Now, one epiphany that...
Is that a word?
It is, yes.
Oh, okay.
Yeah. I can, although I couldn't before I started this. But one epiphany that we might have thought Diebold and Rudbush drove a stake in was the notion that as an expansion ages, excesses or imbalances or misallocations accumulate, rendering the probability of recession more likely. But I can confirm in the post-depression, Diebold and Rudbush were looking at post-war. I view post-war as a bit of an arbitrary demarcation, but post-depression, I can confirm their finding that the marginal effect of an additional quarter of expansion age on the probability of death is statistically no different for a 10-year-old US expansion versus a 1-year-old US expansion. And that is even more pronounced in the United Kingdom, where the point estimate of that slope is basically 0. But Diebold and Rudbush were only half right, because they said that this was a phenomenon of the post-war US economy, but that pre-war US economies did die of old age. Imbalances accumulated. Well, that wasn't true for the United Kingdom. Both pre-war, both pre-depression and post-depression, UK expansions were statistically not likely to die of old age. And actually, the reason these lines truncate where they do, so at 42 quarters for the United States and 104 quarters for the United Kingdom, is those correspond to the longest expansions observed. And we're going to come back to this. Over the past 325 years, the United Kingdom economy has been vastly less recession prone than the US economy.
Then why isn't it 100% at the right hand?
So it converges cumulatively, it converges. But I just truncate it there because we haven't, it goes on, you can extend it out, but I just truncate it there for visual purpose.
The only longest expansion we've seen is 41 quarters. Then conditioned on expansion lasting X, you have one data point, and it must be that you had death at 41 quarters. You can't do 42 quarters. It's understanding how you move the graph.
So I just estimated a clog log here that's regressing the probability of death on age.
Okay.
Yeah.
Parametric is the
Yeah.
answer. Okay.
So UK economies have never, UK expansions have never died of old age. Now, the Diebold and Rudbush is finding that pre-depression US expansions did die of old age. I can confirm that. I mean, you see that line is very sharply upward sloping, and I can reject the null that it's 0. But that's using the official MBER series, which is Christy Romer has demonstrated before 1927, and Joe Davis has demonstrated before 1927, that probably overstates the amount of time that the US was in recession. If we substitute in the Romer dates, then that slope is 0. The intercept is higher because US expansions were shorter lived in pre-depression, but the slope is 0.
Imbalances accumulated in the pig iron production, or whatever was used to impute the recessions.
No, I mean, no imbalances accumulating. No, it's because if you use her dates, pre-depression US expansions didn't die of old age
The
either.
imputation, the old set of imputations run in narrow set.
Right,
They're
right,
both on
yes,
different
yes,
sets
I
of-
see what you mean. Yeah.
That's
So a way of weighting.
Be based on data.
Yeah, correct.
And the data are just much less complete. I mean, we only had national income accounts starting with the 30s. So it went back sort of, but
Yep. And what's interesting, you can actually go back on an annual basis to 1700. US expansions were likely to die of old age, according to using the old NBER series going back to 1790. This was the Moore and Zarnowitz extended series. But if you substitute the new Davis series, it actually slopes down. Statistically, it's no different from zero. The UK also slopes down, which suggests, if anything, UK expansions were less likely to die the longer they lived. It turns out that's because of a correlation with war.
okay.
Because basically, the longer a sort of 18th century UK expansion lived, the more likely it was in a time of peace. So the probability of recession was highly correlated with being in war, and peace was highly correlated with being in expansion. So if you correct for that, you get a modestly upward sloping line for the UK, but it's statistically no different from zero. So basically, US and UK expansions have never died of old age. And what about recessions? Well, like Diebold and Rudbush, I can confidently confirm that post-depression US recessions have died of old age, but that is not true for the United Kingdom. So Diebold and Rudbush said, the age dependence of post-war recessions is a function of institutional changes since the 1930s, an expanded state. Well, the United Kingdom had that as well, but their recessions post-depression seem to be pretty age independent. Diebold and Rudbush also found that pre-war US recessions didn't die of old age. Again, they attribute this to institutional changes since the 1930s that shortened recessions. But again, this is a function of the old NBER chronology. So if you use, if you just take out the misidentification of the 1873 to 78 recession, which the official chronology lists as 5 years, but the revised chronology says it's only 2. If you just take that out, then pre-depression US recessions also died of old age. You can confidently reject that null that the slope is 0. And for the UK, pre-depression UK recessions died of old age, and post-depression UK recessions actually, if you strip out a very unique recession in 1943 to 47 at the tail end of World War II, just stripping that out, that outlier, then post-depression UK recessions also died of old age.
Basically, the standard definition of growth rate, negative growth rate, as opposed to level being low. It's also a way of thinking of, when is the level low? How long does it take for the unemployment rate to cross back to where it is? My impression is those things are even more Poisson processing than the growth rate definition.
Yeah, I think that's fair. I think that is fair. My key takeaway from all of these graphs is that fundamentally expansions have never died of old age, in contrast to Diebold and Rudbush, and recessions have always died of old age.
Getting back to John's point, you can have very, very slow recoveries that take many years to get back to the pre-level, like in after the financial crisis, the Obama expansion was very, very slow since World War II. And those were things bounced back quickly, and Milton Friedman had the violin analogy, etc. But are you going to tell us what you think is going on here?
I am getting to that. Yep. And we might also ask the question, do longer recessions follow longer expansions? And the answer to that is an unequivocal no. There is nothing about the duration of an expansion that tells us anything about the duration of the subsequent recession. If anything, post-depression US recessions, post-depression, shorter recessions might follow longer US expansions. I wouldn't place much stock. I mean, it's not a big sample size. So basically, no, there's nothing about expansion duration that tells us about recession duration.
You can get to the kind of more fundamental point about maybe that Lucas would make if he was still alive at this. Looking at the longer term growth, it'd be accumulating how much cumulative growth there was and comparing that to how much cumulative reduction there was and coming back, et cetera, rather than just sharp turning points.
You have jumped pretty much to my conclusion. But to the the plucking, yeah, I mean, there is a question. Well, is there something about the trough to peak percent change, cumulative trough to peak percent change during an expansion, or the peak, the trough to peak rate of growth during an economic expansion? Is there any information in that that tells us about the peak to trough decline or the pace of the peak to trough decline during the subsequent recession? And if you look at rows 1 and 5 for the US and UK, no, there is absolutely nothing in the trough to peak percent change that can tell us about the peak to trough percent change in the subsequent recession. And look and check out some of these R squareds. I mean, it explains none of the variation. But the peak to trough percent change during the recession can explain a lot of the variation in the trough to peak percent change in the subsequent recovery. And actually with wall tests, I can't reject the null that slope is actually -1 in the United States. There are some issues with the United Kingdom in terms of there are a couple recessions in the early 18th century that violated the plucking model because there were wartime recessions with big harvest shocks. So sort of quarter to 25% decline in agricultural output in 1705, 20% decline in 1709. But outside of those two, similarly, UK trough to peak increases are very much explained by the preceding peak to trough decline.
It's actually very relevant to an old literature on random walks and unit roots, and also the question of, is it technology shocks or aggregate demand? You're giving a very conventional story. There's a potential output. We fell down below and potential's up there. We'll get back to where we were. Very much a trend stationary shock in the downward direction.
Yes, and I'm familiar with the Campbell and Mankiw paper, and it may be that you and a better Cochrane paper, yes. And yeah.
This is consistent with Milton Friedman's plucking findings, right? And he's got that old, I've read it, the Economic Inquiry article. I think the UK is included. He had a few countries in it, but it's the idea that stronger booms don't necessarily predict stronger or deeper recessions, but deeper recessions predict stronger subsequent booms. This is all consistent.
So this is consistent, and it's not just it's not just deeper recessions are generally on average followed by steeper recoveries. There are also faster recessions on average are followed by faster recoveries. But again, this is on average, and there are exceptions, particularly when there's regime change. And I would contend that 2008, 2009, there was a regime change.
Another thing that's going on over this series is governments are growing and the automatic stabilizers become a much larger feature of the economy.
So we're going to get to that. Yeah.
The 0.6 point estimate is kind of half permanent, half transitory.
Yeah, I mean, as I said, a wall test can't reject -1, but
It also can't reject -0.5.
right, it also can't. Yes, point taken.
There's a recent paper by Beraha and Wolf that finds that, and they have a model that recessions where durables are particularly hit are followed by recoveries that are stronger. And then we actually use this notion in a recent paper on the end of World War II. And the idea is that if your durable stocks go down, then you get this investment boom coming out of the recession.
Yeah, no, composition does matter. So this is real GDP going back to 1790. I mean, we see similar patterns with real investment going back to 1901 in the US and 1830 in the UK. similar pattern with bank lending going back to 1880 in the UK, 1830 in the United States. Not much of a plucking pattern in real consumption. And I think that's because there's just less variation in consumption. It's so
But consumption's
inertial.
forward-looking, it's the present value, future income,
Yep.
it tells
Yep.
you the permanent component, all those great
Yep.
things about consumption, right, Bob?
And I also ask because Reinhardt and Rogoff tell us that recoveries that follow recessions that involve financial crises are slower. The estimated coefficient, this is for the United Kingdom going back to 1700, coded for whether there was a financial crisis during the recession. Those estimated coefficients are 0. And I also substitute the peak to trough decline in lending, bank lending during the recession, and the estimated coefficient on that is actually negative. So if anything, bigger peak to trough declines in bank lending are followed by bigger trough to peak percent changes.
The usual story is not so much the age of a expansion causes recession, but overbuilding, overinvestment, overlending, too much credit, everything they said before Coolidge.
Yeah. So on the overbuilding,
That was the investment, I guess.
Yeah.
You just showed it quite quickly.
yes, there's also all these interwar theorists, they postulate that there are imbalances between investment and consumption. So here I ask, is there anything about the duration of the expansion or the trough to peak percent change in the investment to consumption ratio that tells us about subsequent changes in the investment to consumption ratio during the recession? No, it doesn't tell us anything. But the peak to trough percent change in that ratio and the duration of the recession do tell us something about the subsequent change in that ratio and about real
Financial crisis. Michael Bordo has a paper exactly demonstrating.
Yep. And then this is real non-residential structures because yes, skyscraper index, a lot of people say this is particular to structures, to building things. But if anything, a bigger trough to peak percent change in real non-residential structures investment is followed by shallower contractions. Whereas a bigger annual rate of growth is followed by a slower contraction during the recession.
You may get into this later, but how are events going to factor into these growth and decline of recessions?
That's a good question. And actually, that's why I included this, because we often confuse stocks and flows. So you read even very careful scholars, I won't name names, but super careful scholars, and myself included, will invariably slip into the language as well. There was a boom. There was a Western land boom. There was a railroad boom. And we kind of do it in a hand wavy way. And there's a lot of this about the 1920s. But remember, this is the green line is the flow of building activity. And there was a war, there was a post-war recession, a pandemic, and a wave of strikes in 1919 and 1920, including a major coal strike in 1920 in the United States. So the 1920s were about the flow returning to trend. Because if you look at the cumulative level of building activity, it was just gradually getting back to trend after that long shock, because those were real events. And I think we often cognitively forget about that. I'm somewhat conscious of time, and I don't think you guys will need any convincing that Kitchen, Juglar, Kuznets, Kondratiev cycles. There's nothing informative about lags of past recessions on the probability of recession today. And actually, I do have to note, I've been mentioning a lot of interwar theorists. As all of these Western interwar theorists were trying to postulate endogenous or self-generating theories of business cycles, there was a Soviet economist at Kondratiev's Institute in Moscow who, Eugen Slutsky, we all know Slutsky, he concatenated 10-digit Russian lottery numbers and constructed moving sums, and that summation of random and mutually independent chance causes maps very closely onto an undulating cycle of UK business cycles in the 19th century. So it was a Soviet economist that did that. But, and actually, I probably don't need to convince you guys about just the fundamental unpredictability of recession. So number of false positives for US yield curve spread, UK is littered with false positives and false negatives. And if you go back before the 1960s, yield curve inversions are a banality. So before the period of high inflation, the 60s, 70s, 80s, yield curve inversions are a banality.
It was Paul Samuelson's script that stock market predicted 9 of the last 5 recessions.
Right. And we usually think of bond markets as smarter than equity markets, but they can be wrong too. This is getting to your question, Mike, which is, okay, so they're unpredictable. There's nothing in the expansion that can, or not much in the expansion that can explain variation in the recession, but there is variation in the recession that can explain variation in the expansion. But can we at least ask sort of how have the contours of expansions and contractions been changing over the long run? And here I use the improved Davis annual chronology instead of the official NBER chronology before 1927. And you can see, I mean, with the possible exception of a very long 16-year expansion that ended in 1856, there's a gradual upward trend in the age of US expansions, and similarly an upward trend in the age of UK expansions. But there is no sharp break in 1913, in 1933, in 1945. If I do a sequential test for an unknown number of breakpoints at unknown points, maybe 1807 in the United States, maybe 1769 in the United Kingdom, but no sharp breaks in the 1930s or 1940s when we think of these institutional changes as having fundamentally altered these.
The US, the last 1, 2, 3, 4 kind of stand out. I can't really figure out what the date is. That 1990-ish, 1980-ish, after which
So the long,
Starting in the 60s.
So the longest expansions on record were those that ended in 2019, in 2001, and 1969 and 1990.
60s, the 80s, the aughts.
And you can see here already, I mean, how much more durable UK expansions have historically been.
Look back at the previous, look back at that and we look at the period before the long expansions. There were a lot of recessions and they often occurred quite rapidly on top of each other.
Yes.
Is that going to ever be part of the story, or?
Yeah, so actually I'll get to the regression results. I often I could just stare at these ones. I mean, they look like barcodes, but I could contemplate these endlessly. These are recessions. It's recession age at the time of death going back to 1700. And what really stands out to me, so you have, of course, the Great Depression, which is a lot of shocks, and maybe we can get into those shocks in the discussion. I mean, but 4 distinct banking crises, 3 of which were regional. This is Revolutionary War. This one was fascinating for me. So this popped out in the statistics, available statistics, like money supply, some price data, bills of exchange rates, but above all, trade. It is a 3-year collapse in trade in the colonies. And there was no major war going on. I was like, what is going on here? Pirates. So this is the peak of the golden age of piracy. And Edward Teach actually successfully blockades, better known as Blackbeards, successfully blockades the port of Charleston. They're raiding as far north as Newfoundland. They're intercepting ships going from the Caribbean to Salem, Massachusetts, off the coast of Long Island. So trade just grinds to a halt. But those are the longest recessions in US history. So piracy slash, call it war of a type. War, Great Depression. This is war and some very severe environmental shocks, some really bad winter frosts, followed by spring flooding, and then a bunch of war-related things. This is post-war, well, it started sort of end of the war, and then you have pandemic, you have a wave of strikes, and then this is that exceptional recession that I mentioned that started in 1943, continued after the war as they expanded rationing. So the rationing was actually stricter after the war than during the war. And then 46, 47, you again get a very extreme winter event just after they've nationalized the coal industry. And so the coal is freezing at the pits, and you have 75,000 railroad cars that are frozen at the depots. Coal ships are lashed to the coast. And then as in some of these 18th century shocks, come spring, you have this frozen ground because the system had settled over the British Isles, well, actually it was over the North Sea for over a month. Come spring, the ground is still frozen, and then they get torrential rains and they get flooding. So these are very exceptional recessions.
I was looking at the UK unemployment statistics to see what happened after their war, and their unemployment rate didn't go up much. So I'm surprised, given that they were still in recession, it was the end of the war, that you don't see it in the unemployment statistics. Have you looked at that?
I have, and I think it's in part because there's still a lot, there wasn't as much demobilization as in the United States. They still have a lot of insurgencies going on. And then also you started to have the nationalizations.
So you could have
Supply collapse,
labor
not
government
demand collapse.
Yeah. So before the end of the war, Clement Attlee takes.
How many takes over at the end of the war? He's in Potsdam.
Clement Attlee becomes prime minister.
Labour
and
takes
begins-
over.
Churchill
and becomes
45 now.
Could I ask a question beyond the immediate history? Is there a policy implication in here?
Yes. And I would say we shouldn't look to policy to prevent or end recessions. We also shouldn't look to policy to let recessions play out. Let people apply palliatives because the suffering is real, but do not look to government to either end recessions or prevent recessions.
Okay, so can I summarize that? Welfare, but avoid overstimulus.
Yeah, stimulus is not going to end a recession.
Okay,
So we are,
Turns out
We're
it's
just
not
looking
so
on-
stimulative.
are you in recession, or not? It kind of raises the question, is there such a thing as recession, or is this just, a time series? Is above or below zero a distinct phenomenon in a meaningful sense? And of course, how deep are the recessions? They used to be deeper.
I think it's meaningful in the unemployment sense, as this room knows better than any. You would do a very good job picking out the NBER chronology by just looking at a graph of the civilian unemployment rate, the substitution of
Statistically meaningful, not
statistically meaningful.
not personally
Right,
meaningful,
yeah.
but does a decline in GDP down to 0.1% growth, is that a different phenomenon than a decline that crosses zero and becomes a recession?
Right.
Is the unemployment spikes smaller than they used to be? That did automatic stabilizers actually do any good? Those are questions that you can't just do by counting. Are you in recession or are you in expansion?
Yeah, no, that is true. I do, however, again, to get at that question of how is policy attenuating these episodes of contraction. So here I just regress recession age on time, and also separately on a post-war dummy. And recessions, there has been no effect of time on the average duration of recessions. United, the US and UK, and those R squareds are just basically zero. The post-war dummy using the NBER series before 1927, that does seem like the recessions have gotten shorter in the US, but not if you substitute the Davis-Romer chronology. Whereas expansions have been living longer over time. And yes, post-war as well, but the post-war effect is basically a function of just the time. There's no discontinuity, but we have been getting better at absorbing the kinds of shocks that historically would have triggered recession.
and one more question.
Yeah.
Pre-gold standard, post-gold standard, make any difference?
Well, it's hard to say because of this graph and actually the next four. So these,
Money fixed to gold and money free floating.
right. So this is within cycle variance for real GDP, the unemployment rate, and then I go to consumption and investment, going back all the way to 1700. Well, real GDP is back to 1700 for the UK. Because I'm not interested in growth in the volatility of positive growth. That when we're an agricultural economy, we go like this, but it's positive. I'm interested in the volatility across positive and negative growth during sequences of expansion and contraction. So yes, some people might have found that since the first half of the 20th century, volatility of real GDP in the United States declined, but that was the aberration. It declines to levels that were more frequently observed in the 19th century. And by the way, this is a period, as you know, of the Great Depression and also a couple of world wars. This was Napoleonic Wars for the UK and a lot of wars here for the UK. Somewhat similar story for the unemployment rate going back to 1765 for the UK and 1890 for the US. This is the aberration.
And following up on John's observation, what if you were simply trying to estimate the variability in the growth rate of the US and UK economies? And you forgot whether it's recession or not. Just that's a dichotomous variable. Anytime you introduce a dichotomy into, variation over time, you're going to get some funny things. But if you just estimate variation, what would you get?
So just
Yeah, you just forget about whether it's a recession or not. Just look at the variability in the growth
so
rate
just
over
variability over time has generally declined with the transition from primary to secondary to tertiary production, and also with changes in banking that we've become financially more sophisticated. And I'll actually have a few graphs about just how underbanked the United States historically was. But yeah, I think overall volatility, not taking out are you in expansion or contraction, has generally declined over time.
We had this called the Great Moderation, so it wasn't.
affected by how much growth rate there was at one time? I mean, you're sort of saying expansion doesn't predict a recession, but does expansion predict a slower growth rate?
No. Well,
I expect you to say no, but
except insofar as the deeper you get into recovery, the harder it does become to add more jobs, the harder it becomes to sort of fill unfilled contracts, basically, because there's just less slack.
Did you tell all this to Trump?
This has been researched since 2020.
To Alvin's previous question is very interesting on the gold standard versus current arrangements, because part of the common mantra, I think you're going to find that prices were much more volatile in the olden days. And part of the common mantra is, prices are sticky downwards, so on and so forth. So that should have been bad for recessions back then. If you're finding it wasn't, that kind of overturns a very common, nominal stickiness is really important for recessions, and getting away from the gold standard so you didn't have to have deflations was very important. Maybe not.
Yeah, I think that's generally right. One channel was that when you had adverse harvest shocks, whether it was cotton, or actually mostly cotton, is that you would get a big decline in net exports, which would lead to external drains, which could have a deflationary impulse. So there's kind of this irony that you would have a lot of supply shocks accompanied by deflation. But there were also internal drains, because you would have rural depositors withdrawing their deposits from local unit banks that only had one branch. So you would get internal drains as well. So it's kind of this irony that you have a lot of supply shocks in history that are accompanied by declining inflation in the aggregate. Yeah, Hartley.
Sort of on this topic of pre-1930, post-1930, what do you think, obviously fewer recessions, longer expansions happening, how much do you think is just this being the result of the dearth of banking crises post, one theory would say, well, we introduced deposit insurance in the 30s and we don't really have banking crises anymore. I mean, we had a run in 2008, but that wasn't a traditional bank run. That's another kind of thing. We fixed it with capital requirements. But that kind of explains this sort of longer run. I mean, because when I think about economic history, I think there were a lot of recessions pre-1930s that were just these banking crises. 1907, I forget the exact years, but how much would you attribute to maybe a dearth of banking crisis?
That is a very important question and a very good hypothesis, because it's consistent with mine. And it's actually one of the key reasons that I look at both the United States and the United Kingdom. One is because those are two economies I know. I don't know the economic history of France or Germany very well. I do know those two very well. They have some of the best data extending back a long way. And also, I think it's really interesting to compare two similar economies that are very deeply integrated, that have similar legal institutions, and yet have very different recession experiences. And one of the reasons is, and I'll get into this, one of the reasons that UK was much less recession prone was precisely because of the differences in banking. So from 1825, you have nationwide branch banking in the United Kingdom, and a big national economy is by and large a pretty diversified portfolio. And whereas, as many of you know, you couldn't bank across state lines for most of US history, and even within states, you couldn't operate more than one branch. So I will get into that a bit more as well.
So the development of national markets proceeded later in the US. Ability for the overall economy to balance things out. People move from the Midwest to Texas, et cetera. You know, internal mobility offsetting some of these issues, et cetera.
Michael Bordo is trying to ask a question.
Great, Mike.
I read this book and it's fantastic. I read it about a few months ago, and I recommend everybody read it. So I just love every minute of it. One issue that I've always thought about comparing the US to the UK is, the UK is a settled country. The Industrial Revolution starts way back. It depends on whether it's the early 17th century or before, and grow's pretty slow. Okay, US is a frontier country, and it's really growing very rapidly. And in a sense, it's a dynamic economy. And I've always thought of the business cycles in the US as just a reflection, in a sense, that it was a newer country. I always thought that banking had a heck of a lot to do with it, but there really is a difference. And I think one way to get at this question is, and the data is definitely there. You look at the other European countries. There's tons of data for Sweden, Germany, all the Scandinavian countries, France. I mean, that might get at that question.
I think that's a really good point. And
Another way to look at this is to compare to Canada, because they didn't have the banking restrictions, but they were also a relatively new country. So then you could.
I think those are really good points. Thank you.
But I wrote a ton of papers on that with Hugh Rockoff. I had 4 or 5 papers comparing US to Canada. So yes, I mean that completely agrees with what Valerie said.
And actually, you can see here again with real investment. So this back to 1830 for UK, back to 1901 for US. Lot of volatility in this sort of first half of the 20th century, and for the UK a little bit earlier. Consumption, I mean, it's interesting just to compare, to keep the axis, the vertical axis the same for consumption and real GDP. I mean, you just see how much more inertial consumption is over time.
I don't know if I'd call it random walk inertia.
Fair point. And here again, I mean, this is just asking, okay, is there an effect of time on the magnitude of peak to trough declines in GDP and consumption and investment and the unemployment rate? And there is none in basically either economy. If anything, post-war period in the United Kingdom, you have some bigger declines, but that's in part because you have that deep recession, 43, 47, you have COVID. Basically, each of the UK's 5 recessions since the Great Depression were big ones. Those are big shocks. I'll try to rush through this because I'm conscious of time. And don't worry, I will zoom in on this. But I think just that this perspective is really helpful. So the other aspect of recessions that we're perpetually in search of, because we like a redemption story, or we like to feel that an ordeal was for something. And so we are perpetually looking for a cleansing or reallocative or gales of creative destruction aspects of recessions. And don't get me wrong, I mean, it turns out that, and this is not my research, it turns out that, yes, creative destruction is super important for growth over the long term, but it is on net not enhanced by recessions. And similarly, it's that, and Bob, I should just let Bob speak in terms of the productivity ladder that workers climb is generally pro-cyclical, that recovery is about moving from lower productivity to higher productivity firms, and that ladder collapses during recessions. But here, and also, research and development is pro-cyclical. So here I just ask, I use a Hamilton trend here because Jim Hamilton tells us that we should never use a Hodrick-Prescott filter, but I also very often use a Hodrick-Prescott filter because
Laurie has something to say.
Yeah, do not use his method to create a trend.
Okay.
Because see what it does to World War II.
Yep. Okay. That's really helpful.
Whose method?
Jim Hamilton's method.
Don't use it.
So I do both. For this
By the way, Bob Prescott has a very good working paper that for 2020 discussing the HP versus the Hamilton.
So I'm agnostic, and so I use both. This report just reports the Hamilton, but this is the median and maximum deviation from the trend share of GDP at the peak of an expansion, the trough of the subsequent recession, and the peak of the subsequent recovery. And I mean, these are very, very, and it's an absolute, because if you do mean, then different from recession to recession might be average out to zero. So they're all generally very small. And what's interesting is which these bigger ones correspond to. So, oops. So this is COVID. This is early 1980s when you have sky high interest rates. And actually, so it's negative going into the 81 recession, below trend going into the recession, ended even more below trend during the recession. And this is also the early 80s when it was above trend before and above trend at the trough of the recession because of mining structures. So particularly oil and gas. So there was a lot of drilling in response to high oil prices.
Can I ask a question about, I was just looking up some numbers. In 1941, the British population was 48 million, Earth in America was 130. Today it's 68 million versus 330. So Great UK is like a 40% increase in population, and the USA is 150% or 4 times as much. Okay, well, doesn't labor go into growth? Now, will that have any effect on this kind of stuff?
I mean, it'll affect it'll affect the growth rate, the sort of trend growth rate, and level today, but it shouldn't affect sort of the peak to trough fluctuations in that growth. Would be my intuition. Or well, actually, it could be smaller. Could be in smaller peak to trough declines because
Well, because you're pouring in people all the time, so you're adding to the labor force.
Yes, but I mean that.
Unless they're coming in clusters, but it's been pretty smooth since the end of World War II, isn't it?
I mean,
we don't know.
Immigration.
Yeah.
I think between growth and fluctuation. Immigration peaks before 1920, sort of 1890 to 1910 is a huge peak, and then of course it increases recently.
And the overall facts about the population are trivial to say.
Oh yeah, fertility rates are much higher.
There's 4 million people added to the population at birth. And that's true whether you look at 1960 or 1980 or even recently, it's always 4 million. So demography is extremely easy.
Literally, that's true.
Yeah, the numbers.
Okay, and actually you can look also at employment by industry sector, similar story. And incidentally, I mean, here you've got COVID, and this, Valerie might appreciate this. This is a big rise above trend at the end of World War II, followed by a big decline below trend in the immediate aftermath of World War II. The others are all, I mean, the median deviation is 0.1% for all the other categories. Similar story for the UK, going back to 1920. Going back before 1920, I can't calculate shares because these are all index values. But we can ask, what is the effect of a trend deviation at the peak of an expansion on the trend deviation at the subsequent recession trough? No relation for industry and services. If anything, a positive deviation from trend for agriculture is followed by shallower contraction in the subsequent year, or at the subsequent trough. I think that's probably because, you know, if you have a bumper harvest, you're probably going to have some good coal piles and seed stocks for the next year. And you can go into a little bit more detail at the industry level, going back to 1870. So it's similar. Now, so I'm rushing through because I'm conscious of time. Now we kind of go back to Hartley's question, which is, you know, how correlated are US and UK recessions? Because we tend to think of recessions as globalists, but it turns out they're often pretty patriotic. So on a quarterly basis, these are the correlation coefficients. And from the start of a recession on a quarterly basis, they are basically uncorrelated. And just being in a recession, it's a pretty low correlation. On an annual basis, it's a bit higher, and that's been rising over time. So it's about it's about 0.5, the correlation coefficient. But as I noted, I mean, the US is just historically much more recession prone and much more likely to lead than lag entry into recession. So since 1700, US has had 68 recessions. Since the Great Depression, we've had 15. Since 1700, the UK has had 60 recessions. And since the Great Depression, they've had 5. And I think this differential recessionary experience helps to illuminate what causes recessions. So 2001 is a little bit different. I mean, so the UK sailed through 2001. They were adding 20,000 jobs a month in a much smaller population economy. GDP grew throughout. With the US, and they didn't have the following shocks that the US experienced that I would list in reverse order of importance. And John, you're gonna shake your head at one of them. But so no 9/11, direct 9/11 shock. Second, no permanent normal trade relations shock, which had a very immediate effect on gross hiring in durable goods manufacturing. And this was the first recession for which we had jolts. Or much more limited energy price shock, because by that point, UK was relying on coal and North Sea gas. And Valerie and I were talking about this earlier. Gas is a very fragmented market. That is, I mean, because it is so much cheaper to ship through pipes. And so those are very fragmented markets. And then the fourth shock the UK didn't have was the bursting tech. I hesitate to use the B word, but a bursting.com bubble.
This observation relies something that's been kind of an undercurrent of a lot of the conversation here. The UK was more stable, but was growing at a much lower rate.
Exactly. Yeah.
Which gets to kind of the most fundamental question in macroeconomics, right? How much should we worry about recessions? And would an alternative universe where we did a lot more to try to stabilize things result in much less prosperity over time?
So, I mean, that is my conclusion, is that we worry a lot about recessions, and we punish, and actually it's hilarious because we always punish Irving Fisher, brilliant guy. We punish him for that remark about the permanently high plateau. He had some very technical, very academic reasons for saying that. Investment trusts were diversifying, the dollar depreciated, so US equity valuations would be higher. He noted a number of other things. That quote was printed in response to Babson, who was another forecaster at the time, who just the day before had given a speech for the National Business Conference. And he said, I repeat what I said at this time last year and the year before, that sooner or later a crash is coming. He goes on, sooner or later the stock market boom will collapse like the Florida real estate boom. Someday the time is coming when the market will begin to slide off. Sooner or later, someday, he was the 1929 Nouriel Roubini, but he is now permanently celebrated for correctly calling that. And Irving Fisher is denigrated. But
Paul Samuelson was a player. He said, if you have to forecast often.
oh, and by the way, yeah, Babson's reason when he predicted recession the prior year at the same event was because he said if the Democratic candidate for president won, then we would get a recession. So he just changed the same prediction, but just different rationale. But yes, a fundamental conclusion of the book is we worry a lot about over the long run, 20% of years in which the economy is in recession. But the US is much more recession prone historically than the United Kingdom is, but we're also 30 to 40% richer per capita.
You got marginal tax rates.
Oh, I mean, you have all these things that feed into the potential growth.
Yeah,
Potential
well,
growth.
I know, but I think they're very important. And I didn't hear you utter one word. So, okay, never mind, just my peak.
Bordo has a question.
Mike,
He's been
yeah, sorry.
waiting very patiently.
Okay, I want to get back to the debate you had with Hartley about, the transmission of recessions. I mean, there was a ton of work done at the NBER. Anna Schwartz and Lothian and Darby had a big book. I did stuff on this. Okay, that under the gold standard, there was a lot tighter correlation between recessions in the US and the UK than afterwards. And you didn't talk at all about the international monetary regime here, and I think that's important.
Yeah, that is a really good important point, Mike. And one of the interesting things is drawing inspiration from Friedman and Schwartz's unappreciated book on sort of velocities, relations and velocities between the US and UK. I think it came out in 1980. I sort of updated that and looked at all these macroeconomic correlations between a bunch of variables. And the UK historically imported a lot of nominal shocks from the US. But what's really interesting is, some really high correlations in some of these nominal variables. But look down here, their monetary base isn't changing much. Real consumption is not changing much. The real variables aren't changing much. And the population of banks is the least correlated. So they import a lot of these shocks, just on a quarterly basis, but the money supply doesn't change much and the number of banks doesn't change much. And I think this goes back to Hartley's question. These are the number of bank failures. You can't even see the UK bank failures here. You see the rate a little bit here.
There's a lot else besides the rate of failures. First of all, we started with 12,000 banks back then.
Mm-hmm.
We have maybe 5,000 now. England has 90% of assets are held by 5 banks, maybe something like that.
Yep.
And in Europe, traditionally investment banks have been inside large commercial banks. We've also seen this big change. I don't know what the data are. Hey, you go back to the 80s and early 90s, and 70% of credit extended by financial institutions, only 30% direct to credit markets. That's flipped, and now mostly it's just been direct to credit markets. So banking in that sense has become formal banking as opposed to shadow banking. Has become much less important. So I don't know what the same thing's going on in the UK, but those are going to compare to using the financial system. Those are important things to see.
Yeah. And so with the UK, for much of the 18th century, they had this 6-partner rule. A bank can't have more than 6 partners. So basically the only way to provide more banking services to a growing British economy was to have more little banks. So that's why the population per bank was declining. You had a lot of British banking crises during this time, in particular 1825. After 1825, they scrapped that 6-partner rule and they immediately start to amalgamate, to merge. And the most common form of exit from UK banking is amalgamation or merger. And the population goes up. Whereas in the US, I think it troughs at like 4,000 people per bank, like 3,900 people per bank in 1920, 21. So whereas in the UK, look, you're up at 250,000. I don't think there was actually a drop. It's just different measurements like co-ops and stuff. But yeah, that is a story of British banking stability, because after 1829, by the end of the 19th century in the UK, you have a few hundred banks. They're all mostly nationally diversified, and so much better able to absorb shocks and coordinate responses to shocks. And that's why they ride through 1866. There's a banking crisis. There's no recession. Okay.
What role did the Bank of England play in the era before we had a Federal Reserve? We had the first bank in the United States before we had the.
Typically a coordinating role. So like in 1866, they said to a consortium of private banks, all right, you guys need to mobilize this fund. We'll top it up, but you guys need to go first.
So JP Morgan did that in 1906 or 7.
Yes. Yeah.
Okay. Got it.
Yeah, not finding a huge difference on the founding of the Federal Reserve is kind of a sad observation.
Yeah, well, we can talk about that one. We had a long period where we didn't have central bank, let's put it that way.
Yeah.
But argue what.
Tyler doesn't show a huge decline in.
No, absolutely, I'm just saying. If you're examining the financial system and what's going on, that's a pretty clear difference. And you can tell what they were actually doing rather than they were just chartered.
And, okay. Oh, and I know Mike has written a ton on this. But as you just said, there was a cost to the UK. So yes, they were super stable. They had a lot of people per bank, a nationally diversified banking system, but that meant that you had a few hundred banks that were not in the business of extending credit to people without much credit history, without much physical collateral. And in 1930, there was a parliamentary commission that the Macmillan report that identified the Macmillan gap. That was basically UK banks are doing a terrible job of channeling savings into small and medium-sized British enterprises.
Harold Macmillan or somebody else?
It was another Macmillan, yeah. So yeah, that's a big problem, or trade-off, you could say, for the UK. I'm conscious of time, so I'll just add, so 1825 to 1947, you could say one of the key reasons for British banking stability was that they didn't have these adverse banking shocks or the amplification of adverse shocks through the banking system. The other period of greater British stability was 1947 to 1973. So they go that entire period without a recession. We had 1948, 53, 57, 60, 70, and then we get to 73. And what's really interesting about those immediate post-war recessions in the United States is you don't have to buy Jim Hamilton 100% to recognize that oil supply shocks were a major factor in each of those recessions. And that was at very little minimal impact or relatively little impact on the United Kingdom. Why? Because for the duration of that period, coal supplied between 75 and 98% of UK power gen. And you cannot, in the short term, those are not substitutes. I mean, often different grades of oil are not substitutes, but coal and crude oil are not substitutes. You cannot run a ship that was designed to burn coal to burn oil. You cannot just put oil into a power generation plant. And households, they burn coal. They can't just substitute oil. So that was a really, really big factor, I think, in that 1947 to 1973 period. And crucially, the UK went that entire period. Actually, they went from 1926 to 1972 without a coal strike. If you go back before then, you have coal strikes for the 1893 UK recession, 1900, 1902, 1920, 21, 26, 27, and I'm listing both US and UK. And in my 2 minutes remaining, I will take us back to Long and Plosser. I think you have two different types of shocks. You can either have aggregate shocks that affect all sectors relatively indiscriminately, even if linkages between sectors aren't particularly high, and the elasticity of substitution between inputs is high. Or you can have sector-specific shocks in the context of high linkages between sectors and low elasticities of substitution, at least over a 12-month horizon, which is the duration of the average recession. And both matter. I mean, we had credit controls in 1980, the reauthorization of that authority in 1969. We had credit controls in 1949. We had rationing in 1946, 47. Those macro shocks matter, but much more frequent, if you go back over the long run, are those sector-specific shocks Energy is a big one in the 18th century. Of course, an energy guy would say, or an employee of an energy company would say that. But 18th century, turf and provender. The biggest thing they mention in the aftermath of harvest shocks, it's not the hunger. It's not it's the famine in fuel, turf and provender, the animal feed for draft power. And then you would often get 1900, 1902, 1926, they talk about the fuel famine in coal as a result of the coal strikes. And then you often get in 1857 and 1873, people write about these banking crises as if capital, the nation's capital has gone on strike. The nation's capital is only willing to work for ever higher rates of interest or not at all because they just can't figure out, how valuable is the collateral. So I think, Long and Plosser were onto something, that those sector specific shocks are really important. Thank you all.